Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
When I met you in the summer.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome back to another episode of the Equity Mates Summer Series and a Happy New Year. This is a podcast where we explore everything that is possible in the world of investing. And if you've just joined us for the first time this year, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. It's a new year, but one thing that doesn't change is how excited I am for this content,
That's right.
for this series, and to keep learning about investing.
Yeah.
Now, over the course of this series, we're speaking to some of the best financial advisors and investors in Australia to understand how they invest, the lessons they've learned throughout their career, how they would start investing if they had to restart again today, all to draw out some actionable insights that we can take and apply to make 2025 our best financial year yet.
And today, joining us in the studio is Chris Wheldon. So Chris is now a private investor, but has extensive experience across global public equity and domestic private equity markets. He was formerly the Portfolio Manager of Magellan's high conviction strategy and an expert that we've had on the show many a time before and just love speaking to.
Yeah, I think the first time we spoke to Chris was 2018 or 2019, like pretty early in the Equity Mates journey. And he's always one that has really stood out to us in terms of just like the amount that we've learnt from talking to him.
Yeah.
Yeah. And so this conversation was no different. It was full of really interesting insights. But particularly, every time we've spoken to Chris previously, it was about public market investing. Yeah. It was about finding, stocks that are growing or that are undervalued and investing in them. But Chris is now investing in private markets, but particularly the smaller end of private markets, and he's really riding the intergenerational wealth transfer that's happening as baby boomers retire, as they sell their businesses, and as they move on with their lives.
Yeah.
And it is just a fascinating world where it's a completely new opportunity set and a completely new competitive set. And it's like, what are the new investing lessons that he's learned, and what are the things that are timeless and transcend asset class and market?
Yes, we're certainly obsessing over this idea here in the Equity Mates office at having learnt a little bit more about the opportunity. And we should give a shout out if you have parents or grandparents that are looking to sell their business.
Yes.
Hit us up and we'll be able to connect you.
As much as we love Chris, tell us first, please.
Tell us first.
But look, speaking of investing in private markets, we should say a massive thank you to our series sponsor, Viola Private Wealth, who is supporting this series and supporting their clients invest in all kinds of interesting and exotic asset classes.
That's it. Viola Private Wealth combined decades of experience with a dynamic approach to investment management. Managing over $2.5 billion in assets, they help high net worth individuals and families navigate an ever-evolving financial landscape with confidence.
Charlie Viola is consistently a top 5 financial advisor on the Barron's 100 list, and we can't be more thankful for his support of Equity Mates and for Viola Private Wealth's support of this series. So to find out more, head to violaprivatewealth.com.au.
Without further ado, here is our interview with Chris Wheldon. Well, Chris, welcome back to Equity Mates.
Hi guys, great to see you.
Yes, very excited for this. Now, we're going to start with the concept of investing being a lifelong journey, something that, everyone is always working on to try and master, but perhaps never quite does. And we're always interested to know what our guests are working on in their pursuit for excellence and mastering the discipline of investing. So what are you working on right now?
Yeah, I agree. It's a lifelong journey, and that's what makes it fun. I'm still spending a lot of my time trying to find and invest in strong, durable, advantaged and well-run businesses. Maybe the more recent twist is that I'm looking in private markets for really good small and mid-sized businesses to acquire and to partner with, as well as still scouring, global public markets. The private stuff is always something I wanted to do. I can remember back to one of my first performance reviews at Magellan many years ago, and speaking about wanting to scratch that itch of all the lessons and all the learnings that come from being inside the four walls of a business. Because as public or listed equity analysts, portfolio managers, you spend the whole time outside the four walls of the business trying to look in, peek in, understand what's going on inside the business and what its future prospects might be. And I guess I can kind of relate my own lived experience at Magellan. I knew far more about what was going on inside the business because I was on the inside than I would have if I was just a external shareholder relying solely on the information in the public domain. It's a completely different lens and a completely different level of understanding. So it's always, it's a curiosity I always wanted to follow into private markets and really try and explore and understand what Buffett meant when he spoke about being a better investor because he was a business person. That there's plenty of lessons from public markets that are transferable into exploring these private opportunities. But equally, there's a pretty enormous learning curve to go up when it comes to sourcing and diligencing, completing and then executing on those private opportunities. And being on that learning curve, again, it's certainly been frustrating at times, but it's also been a lot of fun.
Now, Chris, you've really opened a door here when we're talking about private markets, and especially like the smaller end of private markets in Australia, because it's something that we've often chatted about. Bryce especially has been really interested in the, there's a lot of talk about the great wealth transfer in terms of baby boomers passing down their assets, but there's also going to be a big transfer of businesses, and there's going to have to be buyers for a lot of businesses that are run by baby boomers. And we're sort of seeing an industry emerge in the US, but at least as far as we knew, there wasn't much happening in Australia. So the fact that you're sort of in that space and seeing what's going on has really piqued our interest. So can you just tell us what is going on? Like, is there a robust private market that we're just not really aware of?
There is. I'm not sure how robust it is. Look, the big picture, the demographic dynamic that you mentioned, Alec, there are plenty of interested parties who are trying to help transition those smaller mid-market businesses that might have been founded 20 or 30 or 40 years ago by a vendor who these days might be in their 60s or 70s or 80s, who may not have the kids involved in the business, but will need to think about transition and succession and what the right home for their business will be. And look, at the big end of town, there's very well-established private equity buyers. In the small and mid-market, it's less established. You've got private individuals, you've got some high net wealth and family office groups, you've got competitors looking to buy each other out. Increasingly, you've got some search fund. The search fund model has found its way from the United States increasingly into Australia. There are more attractive buyers today than there probably were 5 or 10 years ago, but I'd say still there is more supply of these business opportunities. There are still more sellers than there are good buyers at this point in time. But I think slowly that's balancing out. But I think oversimplifying, it's probably still a buyer's market at the moment.
That's encouraging. So, Chris, I imagine it's been a pretty steep learning curve coming from public equities into, being a private investor and not only remaining in public equities, but trying to build out a private, equity portfolio, so to speak. So what is the process that you go through to learn the skills about analysing these private businesses? And I'm also interested, are there any tools and resources that you had access to as a professional investor in the equity space that you've continued to use in your private endeavours?
The short answer, Bryce, is not really in the private space. A lot of the tools that we would rely on in the public markets was really about sort of aggregating and collating information, and there are wonderful service providers out there doing that, but that will suck in historic financial data, it'll collate expert calls, it'll just aggregate a whole heap of useful information. None of those services, sadly, exist in public markets, at least at the sort of small and mid-sized opportunity universe. So maybe there's a business opportunity for you boys to think about. Frankly, it's a lot more just grunt work. It's picking up the phone. It's doing sort of cold outreach via calls and emails to business owners. There is a pretty well-established broker and intermediary community in the small and mid-sized space. There are pros and cons of dealing with brokers in that channel sometimes. The small and mid-market advisory community can be very helpful, both in terms of the buyer, but also sort of making sure the seller is ready to sell and can kind of hold their hand through a process that, let's be honest, most of these sellers will have never sold a business before. So they need a lot of help, a lot of guidance, a lot of assistance. And it's great when there is a professional and sophisticated intermediary involved helping them through that process. But that's not always the case. Sometimes you're doing a sort of proprietary process and a lot of that hand-holding falls back on the buyer to sort of help them get their books ready, help them understand the process, help them move them through the stages. That can fall back on the buyer a lot of times as well.
Well, Chris, I feel like we've like kind of just cracked the door into what is a very interesting world. And I feel like there's more conversations that we'd love to have with you around what you're doing in private markets and what you're seeing with this great wealth transfer and the like. But we don't want to dwell on it today, because what we really want to do with this series and with this conversation with you today is unpack lessons that you've learned over your journey that we can all take and internalize and use as we try and become better investors as well. And so to do that, we want to start at the very beginning, at your introduction to investing. How were you introduced to it? What was your first taste of the world of investing?
I had no idea what I was doing, and that's the honest truth. In hindsight, I had no right to be investing. I've always been fascinated by business, by the fundamentals, by competition, by why some businesses win and some businesses lose. And I guess in the early days, the stock market was just this thing where you could bet on businesses. That was the extent of my knowledge of what's going on in stock markets. I think I was picking stocks based on their ticker codes.
I haven't heard that one.
Like WTF, right? Like I said, no right to be doing any of that sort of stuff. The best thing that happened, unsurprisingly, was that I lost a ton of money. And when you're young, every dollar of savings really counts, and it really hurts when you lose it. And I certainly did lose plenty investing that way. So it forced me to stop and go back to the drawing board. And I guess I just started reading widely. And I was lucky enough to stumble onto Ben Graham at some point. And Graham leads you on to Buffett. And Buffett leads you to Munger. And then you start seeing names like Seth Klarman and Howard Marks and Joel Greenblatt pop up in everything you're reading. So you start reading all their stuff, and you start eventually reading about the great private equity and VC investors. You stumble on behavioral finance, you stumble across all the great biographies and autobiographies, and sort of on and on and on. So slowly but surely, those tentacles start to spread, and you can cherry pick ideas and you start building your own investing framework. But I think what's really important then is that you start applying that framework. There's nothing quite like the experience of deeply analysing a business and an industry, doing really good work around risk and valuation, and having Mr. Market eventually provide you with a really interesting share price to take advantage of that. And in taking advantage of that price and then seeing your investment compound over time, that's, they're the sort of feedback loops that will kind of cement the process. You learn to sort of iterate on what works and what doesn't work. And look, and when that happens, and it never happens without a very healthy dose of luck along the way, when you start receiving that feedback, it just allows you to constantly refine the process over and over and over again.
Now, Chris, I think one thing that people can take heart from there is that a lot of your learning was self-directed. It was, reading and learning from experience. John Hempton has this quote that every new investor should read 5 investing books. It doesn't matter which 5, but they should just read 5, which I always quite like because I think there's some truth to it. But in all of what you read in the early days, does anything stand out as particularly good that you would direct any young investor to read so they can, take similar steps to you?
Nothing new or unique, right? It's, I still think probably The Intelligent Investor is foundational. If you can kind of really digest those lessons around Mr. Market and margin of safety and just how to think about the stock market, which I didn't know how to do, right, until sort of reading that book. I sort of saw the stock market as this weird, wonderful tool where you can kind of bet on businesses and, trade and things like that. But once you start to sort of really internalize that share market is there, it's almost, it's funny. Imagine a world without it. It's a bit of a gift that we have this thing called the share market where any of us with a very small amount of money can go away and do a ton of work on some of the very highest quality businesses on the planet, do a heap of good fundamental work, get to know the business really well, get to know its competitors, the industry, learn a lot about the management and so forth. And every so often that market will serve you some, pretty incredible opportunities. That's a real gift that we all have access to. Imagine a world without it. It would, it'd be much less fun. So it's pretty incredible that we've got a service or a tool like that. But I think that's kind of the trick, right? It's just remembering that it is a tool for us to use when it's at our advantage to use and to ignore it, most of the time, because there's so much, it's just like this endless torrent of noise and chatter. And, if you can turn that off from time to time and just sort of pay attention to the market when it's feeding you great opportunities, I think that's the mindset that you want to have.
A world without the stock market. What a nightmare. What a nightmare. Now, Chris, thinking back to your early days in, I guess, as your professional career started to really take off, are there any major lessons from that part of your career that you still hold to today?
I'm not sure that there are that many lessons from the very early days. Most of what I knew back then was garbage.
Nice.
I had to move on from those ideas. But I'd say, I still have a very similar attitude and interest to those early days, even if the lessons had to be forgotten. Like I said, I still find the existence of the stock market to be this wonderful gift that we've all been given. But I don't think there's many lessons from those early days. I was forced to leave a lot of those ideas behind and find better ideas.
Well, if we fast forward to today, Chris, like through all your experience now, getting into private markets as well, just like from the totality of your time as an investor, have you developed a personal investing philosophy?
Yes, I have, but it's iterative. So I have a philosophy today, and it's probably meaningfully different from where it was a decade ago. And hopefully over time it'll sort of improve and change a little bit as well. But I think it's really informed by understanding how compounding and compound interest works. A lot of my philosophy, I think, is downstream from that. If you understand that compound interest formula, the future value equals your present value times 1 plus R to the N. It's a pretty fundamental sort of, but simple formula in this investing world. If you kind of really understand that formula and the importance of the rate of return, but really the supreme importance of N, time, you really come to understand that the most important thing is time. Like Morgan Housel says in his book, time does all the heavy lifting in that formula. It's important to have a good rate of return that you earn over time, but not necessarily an optimal rate of return that you can achieve in any short-term period. Because again, you want to be doing things that will keep compounding over time rather than sort of risk impairing it at any point by reaching a little bit too far and then perhaps taking some backward steps. To me, there's probably a real insistence on 4 things. This acronym I've always sort of had in my mind of UQMV, U standing for understanding, as the most important thing. It's sort of Buffett's idea around circle of competence. If you can't understand the business, nothing else matters. Whatever I mentioned, the next three things don't matter if you don't truly understand the business and the industry. Q, quality, why does a business earn excess returns? Why should it continue to earn excess returns over time? There's obviously an enormous amount that goes into that. And these sort of management and agency considerations. Do you have experienced, talented, aligned managers working alongside you, working for shareholders? And then V, value. That's also a critically important piece. You will find in listed markets, businesses you understand, they're really high quality with great management, but they're priced to reflect that. So you've got to sort of patiently wait for evaluation opportunities, which markets will give you from time to time. So for our younger audience, I often try and ask people I'm talking to, 4 questions. If you were trying to achieve a really good long-term investing outcome, do you think you're more likely to achieve that by only investing in businesses you truly understand? Likewise with quality, prospects for earning compounding returns over a long period of time seem much higher when you're investing in incredibly advantaged, durable businesses with great and expanding moats, businesses that are getting better in quality over time, rather than businesses that are suffering at the hands of capitalism and competition, where you might have a lousy balance sheet, you might have regulatory risks, all those sort of things. Again, you're probably going to get a better outcome by investing in the first type of business. Third question, are you likely to get a better outcome with an aligned management team with skin in the game, who's got experience, who's got talent, who's got integrity, all those sort of things? Or, a spiv who's out for themselves, who's short-term, who doesn't understand capital allocation? And lastly, very simple question, do you think you'll get a better outcome buying something for less than it's worth or for paying more than it's worth? So I think if you kind of put all those things together, that's the philosophy that I think through these days. And I don't think there's anything unique or insightful. That's pretty well understood by most people, I think. If there's any trick, it's waiting till you find all of those qualities. We're sort of getting into the psychology of patience and discipline and independent thinking and the willingness to look wrong and to look stupid. It's being disciplined around demanding that margin of safety, even when you found a really well-run, high-quality business. So we're kind of in that the baseball analogy of just waiting for that fat pitch and just letting opportunity after opportunity go by that doesn't make sense.
I love that, Chris. UQMV. It could be UQMVP if we throw patience on the end there. So I'll be putting that one in. And
Chris, I might be wrong here, but you went to UQ, didn't you?
Yeah.
Yeah, there you go. The UQ MVP.
The UQ MVP. Nice.
You've done your research.
So, Chris, does this change when you're looking or spending more time in private markets? Have you changed that philosophy in any way? Or I guess on the other side, has spending time in private markets given you better insight into your view on business and investing in public markets?
The couple of ones that jump to mind, as a framework, it's transferable.
Yeah.
As I think about it while I'm speaking, quality coming from public markets, we have these well-established frameworks like the Porter's 5 Forces and Hamilton Helmer's 7 Powers and things like that. And they are great frameworks for understanding the quality of a lot of large listed businesses. Those frameworks are less transferable into small and mid-sized businesses, to be honest, is my experience so far. You don't find businesses with network effects and massive switching costs and those sort of things. You're often dealing with a very different definition of quality. And I'm still trying to be honest, get my head around how you think about quality in the private markets. Often what I'm finding is they're just it's the compounding of very marginal advantages. You might have a business that's been around for a long time and that has earned a slightly better reputation than a lot of their competitors because they don't cut corners. They do what they say they're going to do. They show up every time. They've got good systems and good processes to deliver a consistently high service to customers. But that's flimsy to me, coming from the public equity world. That's not a particularly strong moat. But as I look at a lot of these small private businesses that have a multi-decade history of delivering excess returns, there's something that they're doing. And there's something that they're doing that's delivering those excess returns and satisfying their customers and, often making their owners very wealthy, it doesn't come out of the textbooks that I've read. So I'm still trying to really get my head around how to define quality in the smaller end of the business world. Management's also a really interesting one because often you're dealing with management that's transitioning out. So you've got to think about how to replace them, and whether that's someone buying the business also with the idea of inheriting that role and buying themselves a job, or bringing in some management to sort of replace the owner. There's all different ways of solving that. But management, in a listed business, you've got a management team that's there and is staying with the business. That's not necessarily the case in private markets. And maybe just the last one on V and valuation. It's really interesting, public markets, the price is the price. You take it or you leave it. That's not always, or that's not the case at all really in private markets. Everything's negotiable. You can negotiate the price, but you can also negotiate terms and conditions and structures and timeframes and downside protections and all these other things as well. So there's just more tools available, more levers you can pull to help solve problems, to get a transaction done that suits both the seller and their requirements, but also you as the buyer. So that's a big difference in private markets. Stepping back, I think having spent a little bit more time in private markets is definitely increased my appreciation for any business that has been successful for a long period of time. Irrespective of whether they're listed or unlisted, capitalism is just so damn hard. And when you're seeing that more from the coalface or inside the four walls of the business, and how you are showing up day after day after day, and it's a knife fight with competitors, I certainly have got a sort of deeper level of respect and regard for any business that's resisted the forces of capitalism for an extended period of time. They're doing something special. That's definitely something that's changed for me over the last few years.
Chris, we're just going to take a very quick pause here and say thank you to Viola Private Wealth for supporting this series. In a changing economy, adaptability and insight is essential. Viola Private Wealth offers fresh perspectives and bespoke strategies to help grow and protect wealth, ensuring security and peace of mind in uncertain times. So to find out more, head to violaprivatewealth.com.au.
We covered off QMV in your framework there. I'd love to also cover off on you, the understanding, and just like from your perspective, as a public market investor for the majority of your career, you were taking minority stakes in these very large businesses. Now you're taking majority stakes in smaller businesses. Does that change how you approach that first step, the you? Like, do you find that you need to have a deeper level of domain expertise or... how are you approaching that?
The short answer is it's a great question, Alec, and the short answer is yes. Like we were saying a little bit earlier in the conversation, in the public markets, there's so many great service providers out there that will just feed you, inundate you with information. And so you can kind of start to get an understanding, the viewpoint and understanding of those public market businesses. And look, not everyone is going to understand every business. So even though all that information is out there, it still might mean that you go through, and I can certainly relate to my experience, biotech or something like that, or something that was incredibly technical. I could have had access to all the information in the world, but I still wouldn't have understood the business or the industry and its prospects. It's a little more challenging in private markets just because you don't have access to such rich information. You've got to do a lot of that work yourself. But there is upside to doing the work yourself because there's probably fewer people out there doing it. So it probably does mean, I think the thrust of your question, Alec, is you sort of are excluding more industries because it's hard to find good information on them. But when you can find industries that you do have some knowledge of, and I guess I'm a little bit lucky, not overstating this, but just a little bit lucky I was very fortunate to look at a lot of different business and a lot of different industries and business models back in my sort of public equity time. I sort of come with some of that into private markets. So, for example, one of the businesses I'm looking at the moment, without giving too much of the specifics away, is a hardware retailer in a rural town a couple of hours outside of Brisbane. It has a very similar business model to companies like Home Depot and Lowe's and Tractor Supply Company, businesses that I've followed for a very, very long time. This business that I'm looking at it's been around for 90 years. It's very profitable. It's got wonderful economics. It's a local monopoly, but it's a single store. Whereas Home Depot has 2,000 stores or something like that in North America. So again, not apples to apples, but, if I look at Home Depot's trading at sort of 25 or 26 times forward earnings, where you can buy a great business like that on the public markets. This business that I'm looking at, let's see, but I'm pretty confident if we decide to acquire it, like it might be at 2 or 3 times earnings. So not the same apples to apples in terms of quality, but the price reflects that as well. It's a very, very different price proposition. The risk return in public markets is one thing. It's different in private markets. That's inherently a more fragile and narrow business, but it's available at a very attractive price to reflect those increased risks.
Nice. I know what I'll be Googling after this. So now, Chris, drawing on all of your experience across both markets, if you were to set up a retail investor's portfolio today for the next 30 years, I think the caveat is that you can't sell or trade it. How would you invest that? And you can be as specific as you'd like, or do it from a principles-based point of view. But yeah, just interested to get your thoughts.
I'd probably be very binary on this, I think. To be honest, I would either be really, really passive or really, really active. And I don't think there's a right or wrong. It's just whatever makes sense to that individual, their experience and objectives and circumstances, timelines, risk appetite, all those things, and their willingness to do the work. If they're willing to sort of spend hours getting to know businesses deeply, and all that entails, the business itself, its competitors, management, valuation, all that sort of stuff, then there are incredible opportunities out there in public markets and private markets as well, but it requires doing a ton of work. And if that suits the individual, I encourage that. Like, there are wonderful opportunities out there, but it doesn't suit everyone. And there is nothing wrong at all with recognizing that. And I'd be extremely confident that if someone parked their money for 3 decades in a couple of good low-cost ETFs that just passively sort of followed global markets and the Aussie market as well. Again, just understanding the power of compounding, coming back to that, and what 3 decades of compounding at even a reasonably good rate of return will deliver you. That will be a fantastic outcome for an individual.
Love that.
Love that. Now, Chris, you've given us heaps of lessons throughout this conversation, but I'm going to try and double dip and draw one more out of you. So if you think back to, the early days of Chris Wheldon as an investor, looking up stock tickers on the ASX and punting on the back of what you found, if you could share one more lesson with that young Chris and one lesson that you think every young investor should learn, what would that be? It
would be internalizing that understanding of the power of compounding for a young investor. I think that's what we're talking about, right? So I'm not sure there is, as boring as it is to repeat the same answer, I'm not sure that there is a more important lesson. I think what the younger investor needs to understand is that they may not earn the same rate of return as a seasoned, experienced veteran of the investing game, but they can legitimately overcome that experience gap because they have time on their side. And by starting young and getting more time invested behind them, they were very, very likely to come out ahead of that season. Like, time is something that the seasoned, experienced guys can't get back. And if you're starting young in this game and getting some exposure to the market, actively or passively, whatever makes sense for the individual, they can overcome so much of that, disadvantage that they think they might have. Because again, it's the time that does all of that heavy lifting. And if they can get great time, even if they're earning a little bit lower rate of return, they'll still come out ahead.
Does that answer change if we were to talk about an older investor, say, well, you now?
Not
that you're old.
I mean, come on, we don't normally insult our guests, but
older than us.
Well,
just.
It would still be right at the top of the lessons. I think someone in their 40s, 50s, even 60s these days, right? They should have multiple decades ahead of them still. Of course, circumstances will change, and the need for liquidity and all those other considerations would obviously need to be part of the right allocation, and not just capital allocation, but time allocation as well for an older investor. But when you've still got decades of runway on your side, I don't think you do too poorly by still really understanding the power that a couple of decades in the market will give you.
Well, Chris, you're not that much older than us, so I hope for our sake as well that we all have multiple decades in the market left. But where we want to finish is there's a lot of conventional wisdom in the industry. There's a lot of sayings you learn when you're young, a lot of things that you'll hear in the media that perhaps just aren't so. What's some of that conventional wisdom that you think, looking back, is perhaps wrong, should be ignored, maybe is just something that shouldn't be taught at all to young investors?
Yeah, like the easy one that jumps immediately to mind is arguing against the strong form efficient market theory. But I think that's kind of less controversial these days anyway. I think what the question really makes me ponder is that investing, and maybe I think this is kind of at the heart of your question as well, investing is this sort of endless battle between contradictions. It's risk versus return, active versus passive, fundamental versus technical, concentrated versus diversified, top down, bottom up, value growth, humility versus hubris, aggression versus caution. You go on, like greed versus fear, patience versus action, popular versus overlooked. These are just endless contradictions that you're constantly exposed to in investing markets. And I guess the reality is, if you sample broadly enough, you'll find investors that have made money over time doing all of those different things, whether it was concentrated or diversified. You'll find examples of good investors doing those two opposite things, those that take more of a top-down approach versus a bottom-up approach, the value guys versus the growth guys. There is just this endless contradiction of how you should invest, I guess, conventionally. But there's plenty of people that have proved that there's no single right way of doing it. So I certainly don't feel confident to say what conventional wisdom is right and which is wrong, but it's probably up to the individual again and exposing themselves to all those different ideas. We mentioned earlier, sort of cherry picking the ones that suit them, their experience, their objectives, building their own framework around that and proceeding, getting out there, not just reading about it, not just talking about it, but actually sort of allocating some capital, getting that feedback that comes from taking on some risk, from underwriting an investment, from seeing it go poorly or go well. One of the things I've sort of noticed increasingly over the years is how seductive this content treadmill is of you could spend all of your time just consuming this really interesting, fascinating content, and you'll learn plenty from that. But sooner or later, you actually need to sort of pull the trigger and act and take a risk and try something, because there's a whole other range of lessons that will come from that you won't get from the books and the podcasts and the articles. I guess it's a bit like riding a bike. We can read all the books in the world about riding a bike, but until you actually get out there and try and fail and fall off a few times and get up and go again, there's no other sort of feedback like that. And I think investing is a little bit the same. You consume all the knowledge you can, speak to everyone, never stop learning, and you can learn from everything and everyone. But you've also got to get up from behind the desk, close the spreadsheet, shut down the computer and actually go and risk some capital. You'll get a whole heap of other range of lessons that come from that as well.
Awesome way to finish, Chris. Just like when we interviewed you in the early days of Equity Mates, this interview was full of actionable insights for everyone listening. I certainly learnt a lot. So thank you so much for taking the time with us today. We really do appreciate it. It was great to chat.
Great to see you both, guys. Really appreciate your time.
And before we go, a massive thank you to Viola Private Wealth for their continued support of this series. Managing wealth in a dynamic economy requires agility and insight. With Viola Private Wealth's expertise, clients are equipped to not only endure market changes, but thrive in any environment. For more information, head to violaprivatewealth.com.au.
Now stick around, because next episode we are interviewing James Miller from Firetrail, and all I'm going to say is this interview had more stock tips in it than the entire series combined. So we'll leave it there.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.